So, on September 15th, 2008, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection. The filing was the largest in United States history. 158 years of operation ended in a single weekend. The firm that survived the Civil War, 2 World Wars, and the Great Depression could not survive its own balance sheet. In 1844, a 23-year-old named Hayum Lehman left Bavaria and arrived in Montgomery, Alabama. He anglicized his name to Henry Lehman and opened a dry goods store. His brothers Emanuel and Mayer followed. By 1850, the 3 brothers had renamed the business Lehman Brothers. Cotton was Alabama's highest-grossing cash crop, and nearly all of it was produced by forced slave labor. The 1860 census recorded Mayer Lehman as the owner of 7 enslaved people. The brothers began accepting raw cotton as payment for merchandise, then trading it as a commodity. Within a few years, cotton trading became the most significant part of their operation. After Henry died from yellow fever in 1855, Emanuel and Mayer kept the business alive. By 1858, cotton trading had shifted to New York City. Emanuel moved there to open a branch office on Liberty Street. During the Civil War, the firm partnered with a cotton merchant named John Durr to survive the collapse of the Southern economy. After the war, Lehman helped finance Alabama's Reconstruction. The firm moved its headquarters to New York permanently, co-founded the New York Cotton Exchange in 1870, and joined the New York Stock Exchange in 1887. In 1899, Lehman underwrote its first public stock offering. The model worked because it combined commodity trading, access to capital, and relationships built over decades. Through the 20th century, Lehman expanded beyond commodities into investment banking, equity trading, fixed income products, derivatives, research, private equity, and private banking. The firm survived the financial panics of the early 1900s, the Great Depression, and the volatility of post-war markets. It adapted by diversifying revenue streams and maintaining strict capital discipline during crises. By the early 2000s, Lehman was the 4th largest investment bank in the United States, behind Goldman Sachs, Morgan Stanley, and Merrill Lynch. It employed roughly 25,000 people worldwide. The firm posted record revenues and profits year after year. Its stock price climbed steadily. Lehman had credibility, scale, and access to cheap capital. At its peak in 2007, Lehman reported $46.7 billion in net revenue. The firm's market capitalization exceeded $45 billion in early 2007. Lehman was deeply integrated into global finance. It underwrote corporate debt, structured mortgage-backed securities, traded derivatives, and managed money for institutions and wealthy individuals. The firm's balance sheet had grown to over $600 billion in assets. Wall Street viewed Lehman as a pillar of the financial system. But the foundation was already cracked. Lehman had taken on enormous exposure to subprime mortgages and real estate-related assets. Subprime mortgages were loans issued to borrowers with weak credit histories, often with adjustable rates and minimal documentation. Lehman and other investment banks bundled these mortgages into securities, sold them to investors, and kept large positions on their own books. The securities were rated as safe by credit agencies, and housing prices had been rising for years. Lehman's leverage ratio, the amount of debt relative to equity, reached over 30-to-1. A small decline in asset values could wipe out the firm's entire equity cushion. Lehman had become dependent on short-term borrowing to fund long-term, illiquid real estate positions. If lenders lost confidence and stopped rolling over that debt, the firm would face a liquidity crisis within days. By 2007, housing prices began to fall. Subprime borrowers started defaulting in rising numbers. The mortgage-backed securities Lehman held lost value. Credit rating agencies downgraded thousands of these instruments. Lehman's management faced a decision: sell assets at steep losses to reduce leverage, or hold them and hope the market recovered. The firm chose to hold. In the second quarter of 2008, Lehman reported a loss of $2.8 billion. It was the firm's first quarterly loss since being spun off as a public company in 1994. Lehman attempted to raise capital by selling new stock, but the market had lost faith. The stock price, which had traded above $85 per share in early 2007, fell below $20 by the summer of 2008. During the weekend of September 13th and 14th, 2008, regulators, Lehman executives, and potential buyers worked around the clock to find a solution. Bank of America and Barclays examined Lehman's books, but walked away. The US government had bailed out Bear Stearns in March and taken over Fannie Mae and Freddie Mac the previous week. But Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke decided not to rescue Lehman. There was no legal authority for a bailout without a buyer, and political appetite for more rescues had evaporated. On Monday morning, September 15th, Lehman filed for bankruptcy. Its stock became worthless. Clients fled. Thousands of employees lost their jobs within days. Global markets collapsed. The Dow Jones Industrial Average dropped more than 500 points on September 15th. Credit markets froze as banks stopped lending to each other, uncertain who else held toxic assets. The following day, the US government rescued the insurance giant AIG with an $85 billion emergency loan to prevent a cascading collapse. Within a week, the remaining independent investment banks either failed, were acquired, or converted to bank holding companies under tighter regulation. Lehman's bankruptcy filing became a symbol of the 2008 financial crisis and helped cement the too big to fail doctrine into policy and public consciousness. On September 20th, 2008, U.S. Bankruptcy Court Judge James Peck approved a revised agreement allowing Barclays to purchase Lehman's North American investment banking and trading operations, along with the New York headquarters building. The following week, Nomura Holdings of Japan acquired Lehman's Asia-Pacific franchise, covering Japan, Hong Kong, and Australia, and bought the European and Middle Eastern investment banking and equities divisions. That deal closed on October 13th, 2008. Thousands of Lehman employees transitioned to the acquiring firms. Others lost their jobs entirely. Lehman's brand, once a symbol of stability and longevity, disappeared from the financial landscape. The lesson is not about hubris or individual failure. It is about leverage, liquidity, and the gap between asset value and the ability to access cash. Lehman had survived for over a century by adapting to new markets and maintaining discipline during downturns. But in the 2000s, the firm built a balance sheet that required uninterrupted confidence. When housing prices stopped rising, that confidence evaporated. A leverage ratio above 30-to-1 meant the firm had no margin for error. Illiquid real estate assets could not be sold quickly without triggering catastrophic losses. Short-term lenders stopped rolling over debt, and Lehman ran out of cash in days, not months. The collapse was not a sudden accident. It was the inevitable result of a funding structure that assumed markets would always remain calm and liquid. When that assumption broke, 158 years of history ended in a single filing.